Hi, everyone, and thank you for joining us. We're excited to welcome Chris Temple, the editor and publisher of National Investor Publishing, who's here to talk about portfolio decisions for the great stagflation. Mr. Temple, thanks for being here. The floor is yours.
Well, thank you, Stephen. It's great to be here with a Money Show for the first virtual event of 2022. And I know I can speak for everyone when I say we're looking forward to not only more of those, but more of the in-person ones during the course of the year. And thank you folks also for tuning in today. We're going to get right into this. You know, a statistic that really makes you think and is going to inform a lot of what we talk about in the next half hour is that in just under 2 years' time, roughly 1/3 of all of the US dollars ever created in history have come out. Now, initially, that resulted in much of what we've seen for about the last 40 years. We've seen reinflated asset prices, be it stocks, real estate, cryptocurrencies, what have you. But for the better part of one of those, the most recent year now, we have seen that inflation take a turn that we haven't been used to in some time. In fact, just this morning, we got the news that we have yet another 40-year high in year-over-year rises in consumer prices, which came in at an even 7%. Now, everybody was thrilled during the time that the, why isn't my screen sharing now? I need to advance this. There we go. Everybody was thrilled for about a year when the inflation that the Fed has been creating with the excuse of the COVID pandemic was going all into asset prices. But then a strange thing happened. And again, it's something that we haven't been used to up until now. We saw prices continue to go up. We've seen a massive rebound in energy, which I'm going to touch on later on. As far as portfolio decisions are concerned, we've seen food, shelter, you name it, everything go up. And as you, of course, know, for most of that time until the very end of 2021, Jerome Powell, the chairman of the Fed, was telling us, don't worry about it. This is just transitory. And those of you who follow me know I love the old adage, a picture is worth 1,000 words. And this one's probably worth 2,000 when you look at the denial all along of the man who is supposed to be the smartest guy and most important guy on the planet when it comes to markets, the dollar, inflation, all these things could not have been more wrong. And of course, now what he's doing in the recent past is kind of channeling Jake Blues, if you remember from the Blues Brothers, that iconic movie of many years back where John Belushi's character is held at gunpoint in the sewer duct or whatever it was by Carrie Fisher, who he had stood up at the altar coming up with every imaginable excuse as to why his doing that was everybody's fault but his. And we've heard just yesterday in his reconfirmation hearing, we heard much that same thing from Powell again. This is everybody's fault but his. This is the main arsonist who is responsible for the 40-year high in prices and consumer and producer price inflation that we have right now, folks. And now we're going to be looking to him, I guess, as somewhat of a fireman, but don't hold your breath as to how much he actually does. What's been odd during this time is that we have had a situation that historically is unprecedented. I mean, we are not yet at the point, at least as far as the official government numbers go, where we have, quote, double-digit inflation. Yet we already have set a new record for the longest period of time in history with negative real interest rates. And that, of course, means that the level of interest rates, which for the federal funds rate is still roughly zero or a fraction, even for 30 years, where we just barely crept over 2% again, and yet we've got inflation at 6 or 7%. So in real terms, interest rates are negative. They are now at that place for the longest period of time in history. And I don't know if some of us will live to see interest rates ever turn positive again. And we'll talk a little bit about that later on as well. So it really is created up until now, and we still see this lingering. Interest rates ticked down this morning when the new inflation numbers came out of all the crazy things. Bill Dudley, who is a former Fed governor himself, was out just in the last couple of days, doing some Monday morning quarterbacking of his own, which is easy to do since he's not on the Fed's board any longer, and using exactly the term that I did in this cartoon last year that this really is a wonderland, and the Fed is so far behind the curve that we don't know what's going to happen. Now, I alluded a minute ago to the fact that Chairman Powell at the end of last year made a very, very abrupt flip and almost at once went from dismissing everything that you and I saw and lived and spent money on all of last year, dismissing it as transitory, to now saying that, oh, gee, maybe it's a problem. Maybe we did go too far. And so now we're asked to believe that there's going to be a bit of a Scrooge act here. Now, we don't have time to go into every single element of this today. On my landing page here with a money show, there's a number of items I've done, some of them very recent, that goes into all of the different things and much more as far as what I'm going to talk about on this subject today, not only the inflation mix, but what we should be doing with our portfolio. So later on, I commend you to check that out, or my website. I'll talk about both of those again later on. But one of the things that I did point out in one of my recent commentaries is that while the Fed insists, as do most of the fawning politicians who never seriously question the Fed, it's all political posturing and preening and tinkering around the edges. But look, bottom line is the Fed is political, much more than you know. And we're going to see that again in spades tomorrow when we have a Senate confirmation hearing for Lael Brainerd, who was President Biden's vice chair nominee for the Fed. But the political reasons why the Fed just might, for as long as it can get away with it without causing something major to break in the markets, may be of a mind in the coming months to fight inflation a little bit harder. Let's not forget the political tenor in this country. Let's not forget the fact that President Biden specifically and the Democrat Party generally you couldn't be lower in the polls these days. And they're scared to death that this year in the midterm elections, they're going to get annihilated. And so we are going to see some messaging from them as well as from the Fed that they will tolerate a little bit higher interest rates as the Fed tries to play at least some catch up. They will tolerate more pain in asset prices than maybe a lot of people suspect is possible, all because they need, before the midterm elections, to show some progress on getting these rising prices under control. So how all this evolves, we'll see. So you've got that on the one hand. And again, I alluded to this earlier. We've got this 40-year high inflation, which we added to a little bit this morning, huge political pressure. What we're going to be entertained by tomorrow is now what I've called in recent days the fourth mandate by the Federal Reserve. And this is going to add an interesting twist to things that hardly anybody else is talking about, folks. And I need to spend just a minute or two on this. Lael Brainerd was chosen to replace Richard Clarida, who is leaving in a few days as the vice chair, not because Clarida was engaging in some insider trading and so forth, which most people on Wall Street and at the Fed, we all know they do it. That's not the biggest thing on my mind, of course, as far as what is or is not wrong with the Fed. She was chosen because more than anybody else that can be put in this position, she is going to be the anchor at the Fed and the corollary in this situation to Treasury Secretary Janet Yellen, who of course used to run the Fed herself, of basically adding a fourth mandate for the Fed. The Fed always loves to tell us, especially Powell, that the Fed has two mandates given to it by Congress under what us old timers still call the Humphrey-Hawkins Act of the late 1970s. Stable prices, we don't have that obviously, and full employment. We're closer on that score. So what have they added as a third mandate in recent years? Supporting asset prices and make sure they can avoid major losses for investors, or if those come about, they just print more money to eventually cover them up and reinflate bubbles. That's the third mandate, which even last month, after the FOMC meeting, in answer to a question of why the Fed wasn't moving faster, Powell came out, maybe a Freudian slip, I don't know, and admitted that he's not going to move too quick or do anything that would surprise the markets because you got to support them. The fourth thing now, folks, you're going to hear a lot more about this in the weeks and months to come, is that the Fed is going to be part of the process of greening finance. There's a lot of moving parts to that. I'm going to touch on those later on when I offer you a free copy of a recent publication of mine that really dives into that. So watch this hearing tomorrow. I'll definitely be back in front of the TV to do that. So when you add all of this stuff together, where does that take us? I for a long time have said that a lot of the extremes, the extreme camps out there are overly simplistic when it comes to the inflation argument. On the one hand, you've got people who have been saying for years that we're just on the edge of we're all going to be using wheelbarrows like they did in Weimar Germany to carry around our money. If you're an entrepreneur and you think that's going to happen, be the first one to have wheelbarrows with decals of your favorite sports team or pop star or whatever, if you think that's where we're going. On the other extreme, you've got the deflationists. I won't mention the names. You know who they are, at least some of you do. And year after year after year, we hear that we're in for an epic bust. The Dow is going to go back to 3,000. Gold's going to drop to 400, et cetera, et cetera. None of these things have ever happened, nor are they likely to happen. The deflation thing is always a clear and present danger, simply because the Fed, through its hyperinflation, has blown so many darn bubbles. But as we've seen, if that happens, if somebody, some fat-fingered trader starts the dominoes falling, or China can't keep all the balls in the air, whatever, and things start to unravel, they'll just add another zero to the next QE program. It all kind of morphs into this stagflation environment. So what do I mean by that? That term, of course, was with us in the 70s. The stag, of course, is that the economy is stagnating. And as we're going into this new year, the view is on many people's parts, and there's some plausibility to this, that as we come out of finally this last Omicron stage of the variant, everybody's had this thing. I'm just getting over it. Everybody I've talked to has got this thing or has had it recently. But if this is really the last hurrah, as this virus is mutated and loses its punch, can we really get back to work, get back to consuming and stuff? I doubt that. And the reason I do is that through all the money printing and all the stimulus already, as you see here, we have already borrowed so much activity from the future that I think that these huge numbers that we had, of course, from a very, very low point of economic growth for 2021, those are going to prove to be one-off. And even the World Bank is out right now saying that growth is going to be much more subdued this year. New stimulus, the chances of that are between slim and none, as you already know, from the Build Back Better program of the president's being pretty much dead. And last but not least, there is going to start to be more and more of an impact felt from rising prices all across the board, some places worse than others, when it comes to living costs, and that's going to start to reduce economic activity as well. Deflation part, we are a long time from seeing inflation flutter back down, even with the massaged numbers that they use, to the Fed's 2% target. Don't hold your breath for that to happen anytime soon. One of the items on both my website and here on the Money Shows page, where they have some of my work, talks about how sticky inflation is. The biggest two things really, number one being energy. Again, I'm going to focus on that specifically in a moment. Number two, the biggest single disinflationary force of the last 40 years being declining or stagnant wages. That's over with as well. So the Fed will not in the end have any ability to be able to catch up. The risk that some people are looking at right now, it remains to be seen. There's a lot of cross currents here. And down deep in my gut, I still think that if the market really started to blow a gasket, Powell would blink, as he did at the end of 2018, and not quite his first full year into his job. But we'll see what happens. There's no question in anybody's mind anymore. Even the chairman's, even though it publicly took them so darn long to acknowledge it, that the Fed is way behind the curve, got a lot of catching up to do. The best that they can do is to muddle through. We'll have a stagnating economy and prices will stay elevated. If we do get a retrenchment in the next few months or so, that maybe we see the recent headline numbers flutter down a little bit, we're going to settle at 4 or 5%, not at 2. I guarantee you that. The only way we get down to 2 is if we have another crash like in 2008, and then we go back to the drawing board. All right, what is going to stay Powell's hand? Don't forget that the U.S. dollar is the de facto currency of the world. The Fed is the de facto central bank of the world. Sometimes it understands that, sometimes it doesn't. The backdrop globally right now is not pretty. Europe is already on the edge of a recession. China is the big wild card, one of the big ones for this year ahead. Will they be able to continue to pull off this marketized default of Evergrande that I've written so much about recently? And again, that's all on my website. Another thing that the Fed's got to be careful of, and why it continues, as Powell did yesterday, to say a few things here and there, do a few things here and there that give the bears some pause. We cannot have an uncontrollable spike higher in the US dollar, which will come if markets really get scared that the Fed is overdoing things or there's some other problems. The dollar is the path of least resistance is still higher. But one of the things I told people in my latest issue of the National Investor that I'm watching to see if the Fed has to stop or has gone overboard will be the level of the dollar. Keep in mind also that we've already had a massive hyperinflation, especially in the last 2 years, of financial assets. Who knows what accidents are waiting to happen there. So what do we do about all this? You don't sit on your hands, but you've got to do something as an investor. Now, this year is going to be far more volatile than last year was. We've already seen it. This is just a taste of what's to come in the coming months. So you want to keep some powder dry. You want to pick your spots and so forth. One of the things that I love, this second point here, one of my favorite statistics of all time, from the top of the stock market in 1929 to the bottom in April of 1932, the Dow Jones Industrial Average dropped by almost 90%. Yet 1 out of 3 public companies were higher in price during that same time. And I think that what is unfolding for us right now, and again, I go into more detail of this elsewhere, is that we have one of the best times in a long time. And I think this is going to linger for a while, where if you look at fundamentals and common sense and value, you're going to do better than all of the passive investing, which is starting to unravel. So that's going to be a lot of fun. There's a lot of good yield plays out there. I just added 2 more to my recommendations for subscribers just this morning. And I'm going to continue to incrementally do that, mostly in various commodity areas, which I'm very, very bullish on right now. Also look at insular story stocks. Among the companies on my list right now that I've written about quite a bit this week is one that's already gone up several times in price. But I like one-off stories, folks. And this is what you want to be focusing on. This is one of my main focuses with the National Investor. What story out there exists where if they have a breakthrough, it doesn't matter what the broad market's doing. It doesn't matter what the macro situation is doing. If for one of my favorite biotech stocks of all time right now that's on my recommended list, if they really are the first in human trials to come through with a functional cure for type 1 diabetes, I don't care what the Dow is doing. You're going to want to be in that stock if they're successful. So there's a lot of them on my list like that. There should be a lot of them on your list like that too. Finally, energy. I want to talk about. If you've not already seen it, at the end, you're going to be directed to my website to get a copy of a manual of sorts that I wrote late last year, the green issue and more. You see it here on the screen. This is going to be an area more than anything, and there's different parts of this that make investors the most money and also lead to the biggest headaches policy-wise in the coming few years. Why do I say that? We have started a new energy crisis. It has been made, in my opinion, worse by the present administration. This country is not remotely prepared for this green economy of the future that everybody is pining for. We do not begin to have the raw materials and supply chains that we need, ladies and gentlemen, to come anywhere near, in the same county of meeting the president's and other people's goals for 2030, for 2050, for electric vehicles, for decarbonization, and so forth. At the same time, we have led, I have to say, by the Treasury Secretary, who has her present position solely on the basis of her being a founding member of a big think tank that is all about Wall Street making piles of money off this energy transition. Well, Wall Street always makes piles of money off of everything, folks. That's the nature of things. That's why we should have a different system, which is a story for another day. But for present purposes, we are killing slowly a lot of our lingering legacy fossil fuel industry, stuff that we still need between now and when we're ready for this transition. So we're hurting both parts of this. We don't have enough raw materials and supply chains to meet targets, and yet we're starving. It's become fashionable for everybody to disinvest from oil and gas and coal companies, et cetera, et cetera. So even if the economy weakens, don't be surprised if in the next couple of years you're paying Canadian or European-like prices, if you're in the US as I am, for gasoline. And we won't be any closer to meeting these green goals than we are right now. Now, there's going to be a lot of headaches for consumers in there, for investors. Uranium, which is my single favorite commodity / energy story of them all, has already had a wonderful move in the last year to 18 months or so. It's hardly started. So you want to be in that. In my green manual, I talked about the revenge of the old economy. The crude oil and natural gas space has got a lot of catching up to do. These stocks have tread water for 5 years, and there's still a lot of money to be made there. EVs, there's a lot of battery metals, lithium stocks have been good, nickel, you name it, all kinds of things like that. There's also a few on my list that are one-off stories that have nothing to do with the usual suspects of green energy, but there's great technology and companies out there to help clean up the environment, save electricity for consumers and businesses alike, and so forth. Lots and lots of good ideas out there. What do you want to avoid? You want to avoid companies that cannot pass on all of these costs. I had a few retailers on my list for quite a while. The drugstore chains, the grocery stores, they're all gone right now. They continued going up a little bit after I said sell, but look, shortly they're going to be overwhelmed by rising labor costs and so forth. Utilities won't always be able to pass on their rising costs either. Now, quickly before I get to a few questions, I want to talk about some special issues I've got coming up. Besides the green manual, there's ones on the uranium sector, gold, story stock, which is a lot of fun. And last but not least, one of my favorite countries on earth and a new emerging mining destination for those of you that like that sector is Ecuador. So finally, go to my page with the Money Show, go to my website. If you don't have my green manual, you can get it for free. Just join my mailing list, and that will get you the other ones in the coming few weeks as they come out as well. So with that, Stephen, if there's any questions, I brushed through everything as quick as I could and tried to hit all of the high points. Go and fire away.
All right. Well, thank you very much. Our first question here is, how do we get a copy of your slides?
Copy of the slides?
Yes.
Send me an email and I'll send it right back to you. Chris@nationalinvestor.com. I'll send you this PowerPoint.
All righty. Thank you. Next question from George is, what is your outlook regarding gold and silver for this year?
Look, gold, it's interesting. And I'm going to, of course, one of the special issues I'm going to redo here imminently is on that sector. 2015 was the last time gold put up as bad a year as it did in 2021, which to a lot of people sounds strange. And the reason it did that, it underperformed last year, is because the monetary inflation of the Fed boosted everything else. And I mean, look, values change, investors' psyches change. You do not have the percentage of people today who have a normal built-in affinity for gold that you did 20 or 30 or 40 years ago. So what does that mean? That means that generalist investors today, and especially young ones, have no reason to be putting money into gold as either an inflation hedge or any other kind of a crisis hedge when there's just so much out there to make money on. Some of it's silly, okay? Some of these meme stocks and these other bubbles that have been out there, but that's what people have gravitated to. And the reason I think that gold is going to have a much better year in 2022 is because of my stag views of this whole stagflation equation. It's because I think that a lot of things are going to bog down. You can't close your eyes and throw money at the stuff that Kathy Wood does anymore. And I think she's a brilliant lady, don't get me wrong, but the point is that a lot of that stuff just got overly extended. So that's why I think gold's going to do well. Silver will pick up the rear. And look, a lot of that still is going to depend on, does the Fed move slowly and keep a fire lit under all these other commodities, which I think can endure for a while because there's just such massive liquidity still out there. The Fed, even if it gets aggressive, is not going to get rid of it all next week or next month or probably even this year. So again, I think that precious metals are a good place to be this year, much more than they were in 2021.
Alrighty, thank you. So David says he's 100% invested now, no cash. Should I immediately raise cash in the spirit of keeping my powder dry?
I would raise some cash if you have anything that's suspect. Go back, and I'm going to even back up my slides here a little bit. Look at these kind of things. And this is not an exhaustive list, but what do you have that's, let's say, a company that depends on passing on rising costs is going to have a harder time doing it. As I said a few minutes ago, I would not want to own retailers. I would not want to own food wholesalers. I think it's dangerous right now, even food. I think that there's a case to be made that this broad inflation is still going to do well for the grains and meat and things like that. But at some point, input costs are such. And in Europe, they're outrageous because of the largely self-inflicted disaster. I mean, we're going to be bad enough here with energy, folks. In Europe, it's a basket case because of the geopolitics and the idiocy involved in shutting themselves off to natural gas from Russia. So you've got fertilizer costs have gone through the roof. You're going to have food shortages. You're going to have farmers and others that are going to shut down. They're going to go bust when they can't pass these things on. So look at both sides of that. And in your portfolio, if you've got stuff, especially if it's already got big gains, especially if there's no legitimate revenue there or chance for it anytime soon, start to get out of some of those things and into those areas that are undervalued. By recent standards, with the NASDAQ, with the new Nifty 50, with the MEM stocks and so forth.
Alrighty, what's your opinion of cryptocurrency and Bitcoin?
I'm the last guy you want to ask about that in a sense, because I have been AWOL from that entire space. Okay. All I can say to folks is this. For my entire career, I'm in favor of anything that takes the power and control of money out of the hands of the privately owned monopoly called the Federal Reserve and puts it in the hands of the free market. In my view, these cryptocurrencies are not that. They have become speculations. And my attitude simply is this. I like to stick to my own knitting and to what I like, and including the potential breakthrough company I mentioned a minute ago in the diabetes area. I've got more companies in front of me with real technology, real people, real science, real goods that can be 10 or 20 or 50 baggers. I can't keep track of them all. Great stories. They won't all be winners, but a good number of them will. And I've got more than enough to do with that, more than enough potential without playing this glorified game of musical chairs, which in my opinion is what the cryptocurrencies have become. And I know some people think I'm nuts or I'm an old fuddy-duddy, but that's me.
Alrighty, thank you. Ted brought up the mining comment that you made in Ecuador. Which metal or commodity?
I'll tell you the biggest story about Ecuador right now. It's a multifaceted story, but keep in mind that over 40% of the copper mined on this planet comes from the Andes Mountains, and it's either bench on one side or the other, east or west, in South America. The most conspicuous place that has never seen major development until what is just starting in the last few years is in Ecuador. And then the new wrinkles that have been added to this, I should add, are some pretty serious looming political and financial questions in both Peru and Chile, where recent elections kind of throw a monkey wrench into this. I think this Pollyanna-ish notion that the world has had for so long that, well, we'll always have South America under our thumb. They'll never say no to the US. We can continue to import stuff cheaply. No, it's not right. You're going to see higher wages for people in these countries. You're going to see the governments want to keep more for the local people, which is only right. And so That's another thing. So at the moment, though not all is 100% peaches and cream in Ecuador, just as it isn't in the US for that matter, you have a situation where you've got a nascent jurisdiction, a very US and capital friendly government, and it's one of the best emerging mining stories on a planet. Even though most investors remain oblivious to it, the major mining companies of the world are all putting up their tents in Ecuador.
Alrighty, thank you. How would you suggest we encourage more efficient fossil fuel production, keeping the benefits of that efficiency in the US?
Well, I'll tell you, I would go farther than the apparent tone of that question, and I'm hurrying because we're out of time. Get my green manual, read what I say about sustainability in there, because one of the things that still is not part of this equation is that the US has 5% or less of the people on the face of this planet. We consume a quarter, 25% of all of the energy. And we need to do a lot to be more efficient, to clean up the environment. We still need our oil and gas industries, but there's we're tinkering and trying to fight little problems as they come up. There was never the planning years ago that there needed to have been. So we've got a mess ahead of us, but read that green manual. I have a lot of ideas and solutions in that.
All right. Well, thank you, Mr. Temple. We really appreciate your time today.
Hey, my pleasure. We'll look forward to next time.
All right. And thank you again for everybody who joined us as well.